If you're a US expat, you know your financial life is, well, it's complicated. You're earning your money in one country, but you've still got the IRS to think about. The key to really saving big on your taxes is something called the Foreign Earned Income Exclusion. But to get it, you've got to pass a test. Today, we're going to figure out which of the two paths you can take is the right one for you. So, let's get right to the core problem. And it's a big one. The United States is pretty unique in a not-so-great way for expats because it taxes its citizens on their worldwide income no matter where they live. That's right. You could be earning every single penny abroad, and Uncle Sam still expects a cut. It's a reality that honestly shocks a lot of Americans when they first move overseas. But there is a powerful shield you can use. It's called the Foreign Earned Income Exclusion, or the FEIE for short. And it can seriously lower your US tax bill, sometimes even wiping it out completely. But here's the catch. The IRS doesn't just give it to you. You have to actively claim it, and to do that, you have to prove you qualify by passing one of two very specific tests. All right, so here's our game plan. We're gonna look at the two paths you can take, the physical presence test and the Bona Fide Residence Test. Then we'll put them head to head to see how they really stack up against each other. And by the end of this, you'll have a super clear way to figure out which choice makes sense for you. Okay, Section 1, the Expat Tax Dilemma. So the key that unlocks the FEIE is a form called Form 2555. But before you can even think about filling it out, you have to pass what's called the tax home test, which basically just proves your main place of work is actually abroad. Then you have to pick your path and pass either the Bona Fide Residence Test or the Physical Presence Test. And hey, don't just take my word for it. This comes straight from the horse's mouth, the IRS itself. The law is crystal clear. The same tax rules that apply to someone in Ohio apply to you, no matter where in the world you are. This is the whole reason why understanding these tests is so absolutely critical. You know, the best way to think about these two tests is with a simple analogy. The physical presence test, think of it like a stopwatch. It's all about the numbers. It's a strict count of your days. The Bona Fide Residence Test, on the other hand, is all about commitment. It's a much more qualitative look at your lifestyle and whether you've truly put down roots. All right, let's dive into path one, the physical presence test. As we said, this one is all about the stopwatch. This is the more straightforward of the two for sure. It's just a numbers game. The IRS doesn't care about your intentions, they only care where your feet are planted. So here's the rule, right from the book. You have to be physically in a foreign country for at least 330 full days. And notice this part, during any period of 12 consecutive months. That any is super important. It means it's a rolling window, not just the January to December calendar year, which actually gives you some room to plan strategically. Let's just stare at this number for a second, 330. For this test, nothing else matters. Seriously, not your apartment lease, not where your family is, nothing. Just your physical location for 330 full days. It's a beautifully simple black and white hurdle to clear. But, and this is a huge but, here is the trap that gets so many people. The IRS is incredibly strict about what a full day actually means. A travel day where you're flying over the Pacific, that counts as a US day. A flight from London to New York, US day. This means that 35-day buffer you thought you had can vanish way faster than you think. One miscalculation on a flight, and boom, you could fail the whole test. Okay, so if the idea of counting every single day on a calendar gives you a headache, don't worry, there's another path. This is the Bona Fide Residence Test, and it's all about the commitment. This isn't about counting days, it's about proving you have genuinely made a foreign country your new home. The key phrases to zero in on here are uninterrupted period and entire tax year. This means your residency abroad has to cover a full calendar year, from January 1st all the way to December 31st, without a break. Now, uninterrupted doesn't mean you can't go on vacation. It just means your official status as a resident of that country has to stay intact. So how do you prove something as fuzzy as commitment? Well, think of the IRS as a detective. They're going to look at the whole picture of your life abroad. They're looking for evidence of real integration. Do you have a long-term lease? Is your family living with you? Do you have local bank accounts? Are you part of a local gym or club? All these things are clues that tell them your move is for the long haul, not just some temporary gig. Your actions have to build the case for you. And pay close attention here because this is an absolute no questions asked deal breaker. You cannot play both sides. You can't tell the government of, say, Spain that you aren't a resident to get out of Spanish taxes, and then turn around and tell the IRS that you are a resident to get out of US taxes. The IRS sees that as a direct contradiction and they will disqualify you on the spot. Okay, so we've walked through both paths. Now let's put them in the ring together, side by side. This is where you can really see the strategic differences and start to get a feel for which one is a better fit for your specific situation. This table just makes it all so clear, doesn't it? Look at the basis. Pure numbers versus a subjective story. The core rule, a rigid 330-day count versus an entire calendar year of residency. And check out the flexibility. With the Bona Fide test, you can actually spend more time in the US as long as you maintain your foreign residence. You can see how one path, physical presence, is tailor-made for digital nomads, while the other, Bona Fide residence, is built for someone who's really settled in. All right, we've broken down the mechanics of both tests. Now for the most important part, let's get practical. How do you take all this information and actually apply it to your life to make the right call? This really is the question you need to ask yourself. Are you running a stopwatch, carefully tracking every single day you spend outside the US? Or are you building a life, proving through your actions that you have a deep and lasting commitment to your new home country? Let's make it even simpler. If your life abroad is mobile, maybe a little uncertain, and you're hopping between countries, think stopwatch. The physical presence test is basically designed for you. But if you've moved your family, signed a long lease, and you're really settling in for an indefinite stay, think commitment. The Bona Fide Residence Test reflects that reality. Now here's a pro tip that can be an absolute lifesaver. What happens if the tax deadline is coming up fast, but you haven't quite met the 330-day or full year requirement yet? Don't panic. You can file something called Form 2350. It's an extension specifically for this situation. It gives you the extra time you need to officially qualify without stress. And it's pretty much essential for anyone who moves abroad mid-year. So let's say you figured it out. You know which test to use. You know you qualify for the Foreign Earned Income Exclusion. Fantastic. But that leads us to the final and maybe most critical question. Just because you can claim it, should you? You see, there's another tool in the toolbox called the foreign tax credit. And for some people, it can actually save them way more money. Choosing the wrong one can be a costly mistake. But that is a decision we'll break down in our next explainer.